Health insurance premiums are on track to spike by up to 30% for millions of Americans in 2026. Some families could watch their costs triple overnight, even if they stay perfectly healthy. If you're self-employed, a small business owner, or a middle-class family just struggling to afford coverage, the financial future of your household could literally hinge on what you do between now and open enrollment. Here's the kicker. What's coming isn't just another routine increase. It's a perfect storm of expiring subsidies, a government standoff, and sky-high insurance profits. But before you panic, I've got your roadmap. I'm breaking down the 3 survival strategies you need to outsmart the coming premium spike. Practical, number-backed steps that almost nobody, not even many advisors, are talking about. And survival strategy number 2 could save you more than $800 a month if you get it right. Want to protect your bank account and your family's coverage? Let's get into it. First off, let's get clear about the scale of the risk in 2026. You may have heard rumblings, but the numbers are jaw-dropping. Insurance premiums across the United States are projected to jump by around 30% according to KF, the Kaiser Family Foundation, which means millions of people, especially those relying on Affordable Care Act ACA plans, are staring down bills that could double or even triple. And remember, that projection was made before factoring in the current government standoff over healthcare subsidies. As we film this, Congress is still in gridlock. The pandemic-era premium subsidies, which gave relief to tens of millions, are on the chopping block. If they're not renewed, many Americans' only warning will be a shock letter in their mailbox with next year's bill. Pause for a second and think about this. Your insurance plan could be yanked from beneath you, not because you got sick, not because you changed your plan, but because politicians in Washington, D.C. can't reach an agreement. This is Money Masters, and I'm John. Before we dive into the specific survival strategies, remember, this video is strictly educational, not financial or insurance advice. All projections rely on the best available data as of today, but insurance pricings and regulations change quickly. So consult a licensed professional about your individual situation. Let's get into the 3 survival strategies that will help you outsmart the 2026 premium spike. And spoiler, the second one might just be the move that lets you keep your coverage and avoid a 4-figure monthly mistake. Stick with me. Survival strategy number 1. Calculate and plan for your true 2026 premium. Now, not later. Let's anchor with a real-life story. There's a family in North Carolina, self-employed couple, who have been paying about $400 a month for health insurance, thanks to ACA subsidies. Behind the scenes, federal dollars were covering another $1,700 for them each month. What does that mean if those subsidies expire? Overnight, their premiums shoot up to $2,100 a month. That's a $20,400 a year hit to their budget for the exact same coverage. Imagine seeing that letter. How would you react? For reference, I know this pain all too well. Lizzie and I pay $1,100 a month for health insurance, with no subsidy. And honestly, it's not even strong coverage. I'm open to suggestions. If any of you have cracked the code to get it way lower, and I mean half or less, please reach out. But here's the kicker. Nobody is immune to this. Not me. This North Carolina couple isn't unusual. The wife battled breast cancer in 2020. Her husband survived a heart attack in 2024. They're putting in overtime, working extra jobs, and still falling deeper into debt from medical emergencies. And now, raising an extra $1,700 a month just for the privilege of staying insured. It's almost unimaginable for most middle-class families. Now, before you let the anxiety spiral, here's your first practical move. 1. Don't wait for the renewal letter. Get an estimate for your 2026 premium increase today. Plug your age, household income, and coverage details into the KFF subsidy calculator. Or use my free insurance premium survival calculator. Type calculator below, and I'll reply with the link to project your actual costs under different subsidy scenarios. 2. Run the numbers for at least 2 scenarios. A subsidies continue to current rates, and B subsidies cut worst case. Example, if you pay $400 now, with a $1,700 a month subsidy. Worst case is $2,100 a month. Plan for the higher number in your 2026 budget. 3. Prepare in advance. Start setting aside extra cash each month now, even if it means making small sacrifices elsewhere. The earlier you start prepping, the less sudden the impact is. Not sure where you land? Comment your current monthly premium and projected increase below. Let's crowdsource some real numbers and help each other benchmark. Are you facing the $2,100 shock? Or is your increase looking smaller? Drop your situation in the chat. Progress marker. That's step 1. But knowing your new number isn't the same as paying it. What if you simply can't make up that much? And what about families who are already drowning in debt? Stick around, because next up is survival strategy number 2, the one even many financial advisors overlook. Curiosity loop. What's the alternative? If you can't stomach the new premium, you might be surprised. Survival strategy number 2. Optimize your coverage, even if it means downgrading or rethinking insurance. Altogether, if sticker shock seems inevitable, it's time to take control of what you can. That means 3 things: shopping plans, rerunning your needs analysis, and yes, considering non-traditional backup plans. Real-world stories illustrate this. A 60-year-old man in Phoenix just got his renewal notice. Premiums tripling from $300 a month to $900, despite a $9,000 deductible. Even with 2 jobs, he can't pay it. His solution: he's seriously considering going uninsured, saving the difference in cash for emergencies. Now, a quick risk caveat. No insurance means you're exposed, especially if a major health event hits. Medical bills can devastate even a cushiony emergency fund. But as bad as it sounds, for some people, if the alternative is zero coverage, setting aside your old premium into a high-yield emergency medical savings account is actually a more rational plan than paying for a policy you can't use. Not advice, just an option to research with your own advisor. Option 1. Downgrade. A lot of people will face downgrades from gold or silver ACA plans to bronze. That usually means higher deductibles and out-of-pocket maximums, but premiums shave off a few hundred per month. If you're relatively healthy and can take a hit on coverage depth, it might be a workable bridge. Option 2. Shop competing plans. Open enrollment is November 1st. Don't sleep on this date. This is your window to compare every available policy on and off the exchange. Use tools like Healthcare, Your State's Marketplace, and aggregator sites like Health Sherpa or Policy Genius. Run side-by-sides. What's your new deductible? Your maximum out-of-pocket? Which networks are you actually covered under? Option 3. Explore health-sharing plans or direct primary care memberships. These aren't technically insurance, and there are real trade-offs, but they can fill some coverage gaps, especially if you're priced out of traditional plans. Always research fine print. Why exclude pre-existing conditions or big-ticket costs. Option 4. Self-fund with a medical emergency savings account. If you truly can't afford any policy, open a separate high-yield savings account just for medical bills. Set a recurring transfer at least equal to what your old premium was. It isn't ideal, but disciplined saving beats blind hope. Practical tip: when comparing new plans, make a simple spreadsheet with premium deductible, annual out-of-pocket max, and covered services side by side. For example, Plan A $900 per month, $9,000 deductible, $16,000 max. Plan B, $400 per month, $14,000 deductible, $18,000 max. Calculate worst-case scenarios. Can you handle them with your savings? Screenshot this plan comparison setup or comment "calculator" if you want my spreadsheet template. I'll get it to you free. Progress marker. That's your blueprint for surviving premium shock. But here's where you can really gain an edge. A move most people and even many financial advisors won't mention. Next up is the middle-class survival loophole, one that could protect your wealth on multiple fronts. Curiosity loop. You'll want to stick around for survival strategy number 3, because it doesn't just save you money, It could actually help you build resilience against premium inflation, housing shocks, and even job instability. Survival strategy number 3. Financial defense beyond insurance. Fortifying your middle-class safety net. Rising premiums aren't the whole story. The deeper problem: so many middle-class Americans' budgets are so tight that one premium hike or one ER bill could wipe out their family's savings. According to KFF, if subsidies vanish, the average out-of-pocket premium payment will surge from $888 a year to nearly $1,900 for ACA participants. And again, 24 million Americans rely on these plans, with 90% getting subsidies. If Congress does nothing, the Congressional Budget Office predicts around 4 million people could lose coverage in 2026. And it's not limited to health insurance. Premiums for car insurance are following the same disturbing curve: 50% growth over the past 5 years. According to the Bureau of Labor Statistics, some drivers have seen rates triple just by moving zip codes, even with clean records. Example: a worker earning $50,000 a year saw his car premium spike to $400 a month after relocating near New York City. That's 10% of his take-home just for car insurance. Would you surrender your car if it meant a $400 a month savings? For some, going car-free and using a mix of public transit, biking, and car shares is becoming a smart money move, and not just for city dwellers. In Vermont, average annual car insurance is about $900. In Florida, $3,000. In New York, a staggering $4,000 a year. And that's for full coverage. This isn't just luck or bad driving. These rates reflect everything from population density to local accident rates, crime regulatory quirks, and even weather disasters. Layer this on top of the other elephant in the room: most Americans don't have a real financial safety net. Gallup's latest data says 60% of U.S. workers don't have what Gallup calls a quality job, one that meets basic thresholds for financial stability, safety, opportunity, and schedule flexibility. In other words, the majority are already stretched thin before these premium hikes hit. Practical solution: this is where creating a comprehensive financial defense plan matters as much as picking the right insurance. Here's what this plan includes. 1. Build a 6-month emergency fund as realistic as possible, held in a high-yield online account like Marcus Alley or Capital One. Even if you start with just $50 or $100 per month, it's your line of defense against both health and auto deductibles. 2. Audit every insurance policy you have: health, auto, home, even life. List your premium deductible, annual out-of-pocket max, and covered services. Where can you safely raise deductibles for lower premiums? Where are you overinsured? Remove duplicate riders you don't need, but never risk going bare if you own property or drive regularly. 3. Negotiate and shop around even outside of open enrollment. For car insurance, get at least 3 new quotes every 6 months. Use sites like The Zebra or Compare.com to check for changing rates. Even tiny improvements add up over the year. 4. Invest in health, not just with insurance, but with prevention. Small things like using your employer's wellness program, getting annual checkups, or using telemedicine can save you thousands long-term. Some plans offer lower premiums for healthy behaviors or enrolling in fitness apps. Don't leave free or discounted benefits on the table. 5. If you're self-employed or run a small business, consider establishing a health savings account, HSA, or a qualified small employer health reimbursement arrangement, STOR. These accounts can provide you with significant tax advantages and help pay for out-of-pocket medical costs. Run the math using your 2026 estimates to see if maximizing an HSA can buffer some of the premium spike. One bad year of insurance inflation can wipe out a decade of careful saving. Protect yourself now. If you feel that, share this video with a friend who's feeling the same squeeze. Here's the real-world bottom line. Most solutions require doing nothing, hoping the government comes through or the hikes magically reverse. Not on my watch. Take inventory model. Your worst-case premium shop. Smarter and fortify your broader safety net. The difference is survival, not just for this year, but for every financial curveball the next decade throws at you. Progress marker. We've now walked through all 3 survival strategies. Model your premium increase early, optimize your plan, and consider all options. And reinforce your entire financial safety net. Curiosity loop close. But I'll give you something extra: the path forward. If none of these options feels adequate, stick around just a moment longer for a rapid-fire checklist you can use to decide your very next money move as open enrollment nears. Rapid-fire survival checklist for premium hike. Season what to do this week. 1. Calculate your 2026 premium for each scenario. Subsidies stay versus end. 2. Shop and compare multiple plans as soon as open enrollment opens. 3. Decide. Downgrade, switch, or self-fund with a clear spreadsheet-modeled risk review. 4. Run a real census of every insurance expense you have: health, car, home, and audit policies for unnecessary spending. 5. Commit to adding 1 month of expenses to your emergency fund before January, if at all possible. 6. Set up recurring reminders in your phone or calendar to check for insurance quotes and updates every 6 months. 7. Comment below with your predicted premium jump, or what % of your monthly income goes to insurance and medical costs right now. I want to hear your story. Remember, if you want that free insurance premium survival calculator, type calculator below, and I'll reply with the download link. This tool could help you see exactly where you stand before the new bills hit. Finally, let's quickly recap why this matters. Millions of Americans are about to get slammed, sometimes with $700 or $1,700 a month jumps, just for the privilege of staying insured. Cars, homes, and medical coverage all play musical chairs with your net worth each year. The only way through it is to be proactive. Run the numbers. Shop aggressively, build your defenses, and help others in the community who are trying to survive this same crunch. Whatever happens in Washington, you have the power to model, plan, and act well before any shocking letter lands in your mailbox. Our Money Masters community is here, sharing tools, encouragement, and real stories. That's your action plan. Let's make it through this together. If my strategies or my calculator help, share it. Let's build a stronger financial net, no step at a time. Let's recap the core game plan. Model your 2026 insurance costs using both current and worst case numbers. Shop plans aggressively during open enrollment. Don't assume your old plan remains the best fit. And consider safe but creative insurance alternatives if needed. Above all, safeguard your financial defense, emergency fund insurance. Audit and negotiation should be routine habits, not afterthoughts. Immediate next step. This week, sit down with your premium statements and run your numbers through either the KFF subsidy calculator or my free insurance premium survival calculator. Hit your new budget ready before renewal letters arrive. Over the next 90 days, plan out your emergency savings goals and commit to at least 1 active insurance policy audit, whether it's health, car, home. By year's end, try to add at least 1 month's living expenses to your emergency fund, no matter how small the addition. If you follow this approach, you'll be prepared, not blindsided. When premium invoices start landing in late 2025, change may hit hard at first, but these action steps put you in control and help protect your net worth even if subsidies disappear or rates continue climbing. As for results, if you start now, most viewers will feel a grip of relief and control in 30 to 45 days as they solidify their insurance plan and know where their safety net stands. And within the next 6 to 12 months, you'll find yourself better positioned regardless of what Congress or the market decides. Now don't forget, subscribe and turn on notifications because next week, I'll be breaking down the 3 cheapest insurance plans for middle-class families in your state and analyzing their pros, cons, and hidden fees. If you found this helpful, drop a comment with your biggest premium increase or what % of your income is eaten up by insurance and medical costs each month. Your story helps others realize they're not alone. And remember, if you want the calculator, just comment calculator below and I'll DM you the link. Our Money Masters community is all about sharing concrete tools and support. And as always, nothing in this video is individual financial or insurance advice. These are educational resources only, based on best available data as of today, but numbers and laws may change. For personal recommendations, always consult a licensed financial or insurance advisor. See you next time.